Before we dive in, let's get the important stuff out of the way. This analysis is for informational purposes. It's not a recommendation to buy or sell anything. As always, every investment decision and all the responsibility that comes with it rests with you, the investor. All right, let's get started.
Okay, let's get right into it. Right now, the entire market is completely obsessed with AI chip stocks. And hey, I get it. But while everyone is looking one way, the really big, smart money is quietly making a move in a totally different direction. It's a bet on a company that, let's be honest, most of us still think of as a little boring, a car company. But as we're about to break down, they are positioning themselves to be a massive player in the next phase of AI, the physical phase. Welcome to Understanding the World Through Stocks. Today, let's dig into why global capital is placing its bets on Hyundai for 2026. So here's our game plan for today. We're going to start big picture, top down. First, we'll look at why global money is suddenly flooding back into Korea. Then, we'll zoom into the auto industry, which is a total battlefield right now. After that, we'll put Hyundai itself under the microscope, looking at its rock-solid value and the hidden growth story. And finally, I'll walk you through my own practical playbook on how to think about this opportunity from a risk-first perspective.
Look, before we can understand a single stock, we have to understand the ocean it's swimming in. And right now, there's a huge current of global capital that's changing course, and it's heading straight for South Korea. Let's figure out why. For as long as I can remember, there's been this thing called the Korea discount. You had these world-class companies, but their stocks always traded on the cheap. Why? Well, it was a mix of complicated corporate governance structures and, of course, the constant geopolitical risk from just across the border. It's been a real headache. But the big question now is that discount finally going away? All the signs, and more importantly, the flow of money, seem to be saying, yes, it is.
And here's a huge reason why. $56 billion. Starting in April 2026, South Korea gets included in the World Government Bond Index, or WGBI. Now, this sounds like boring financial jargon, but trust me, it's a game changer. It's basically the world's most exclusive club for government bonds, and getting in is a massive seal of approval. It forces giant passive investment funds, we're talking about massive pension funds and sovereign wealth funds, to start buying Korean assets. It's a tide of money that is contractually obligated to come in.
So you've got two huge tailwinds here. First, the government's own corporate value-up program, which is basically forcing companies to be more shareholder-friendly with dividends and buybacks. Second, that WGBI inclusion we just talked about. And this isn't just a theory. According to Bloomberg data, on February 11th alone, foreign investors bought a net 860 billion won of Korean stocks. The smart money is already moving. They aren't waiting for the official announcement.
Okay, so that's the macro picture. The money is coming. Now, let's drop down to the industry level. The global auto market today, it's not a friendly place. It's an absolute bloodbath. It really is like the Hunger Games out there, and the old strategies of just chasing EV growth at any cost are getting companies into deep, deep trouble.
And this slide really nails the core conflict. On one side, you have the EV dreamers. Tesla's growth has stalled, and that stock price is just floating in another galaxy compared to its sales. Then you have Ford and GM, who are literally burning billions of dollars trying to make this painful EV transition work. On the other side, you have the pragmatist, Hyundai. They've played it smart, balancing their very profitable hybrid cars with a steady rollout of EVs. It wasn't the sexy story a few years ago, but boy, is it the winning strategy now.
The numbers don't lie. Just look at this. Hyundai is sitting here with a solid 6.2% operating margin and a 10 trillion won profit. Now look across the table at Ford, an $8.2 billion loss. That's not a rounding error, folks. That's the price of a bad strategy. While everyone else is writing off billions and fighting for their lives, Hyundai is quietly stacking up the cash it needs to fund its own future. And that's the key.
All right, so we've got the macro wind at their back, and they're executing beautifully in a tough industry. Now let's zoom right in on Hyundai the stock, because on paper, it's a fantastic value stock. But there's a huge kicker here that I think the market is completely sleeping on.
Let's just let this sink in. A forward price-to-earnings ratio of 5.5, that is dirt cheap. Compare that to Tesla at around 143, and you're getting paid a very healthy dividend while you wait. Now, in my 20 years of doing this, when I see a valuation gap this wide between major industry players, it doesn't just mean one stock is cheap. It means the market is fundamentally misunderstanding the story. It's missing a whole chapter.
And this is exactly what I mean. The spreadsheet gives you the what, a PE of 5.5, but my experience tells me the why. The market is still looking at Hyundai and seeing the company it was in the 90s. It is completely failing to price in the massive technological pivot that is happening right under everyone's noses.
So what is this huge pivot? What is this hidden gem? It's the reason for that valuation gap. The market has not woken up to the fact that Hyundai is transforming from a car company into a physical AI company.
And this isn't some science fiction dream. Look at this roadmap. It's a concrete business plan. This year, 2026, they are opening a validation center in the US. By 2028, these robots will be on the factory floor doing real precision work. By 2030, they'll be tackling even more complex jobs. This is a deliberate, step-by-step plan to first use the tech themselves, perfect it, and then sell it to the world as a service.
So what do we even mean by physical AI? Simply put, it's AI that can move and work in the real world. For Hyundai, this is the Atlas robot from Boston Dynamics, which they own. And this is not a toy. It has 56 degrees of freedom, which allows for unbelievably human-like motion. And here's the kicker. For industrial use, it can autonomously swap its own batteries to work 24/7. This is a machine designed for the factory, not for a stage demo.
And Atlas is only half of it. The other half is Motional, their self-driving company. They're not just talking about robotaxis. They are launching the Ioniq 5 robotaxi as a commercial service in Las Vegas by the end of this year. It runs on a large driving model, which is basically an AI that learns to drive from data, much like how ChatGPT learns from text. This proves they can master the incredibly complex software side too. So let me get this straight. You've got a world-class robotics company and a leading autonomous driving company, both hiding inside a stock trading at 5.5 times earnings. It's incredible.
Okay, we've covered the why, the macro, the industry, the valuation, the hidden growth. Now let's get practical. Let's talk about how a professional investor might think about approaching this situation. This is the playbook.
For me, this is a disciplined three-step process. First, building a position. You don't just jump in all at once. You could consider a split purchase strategy to average your entry price. Second, you monitor the key dates. Watch for news around that GBII inclusion in April, and then look for updates on the Atlas roadmap later in the year. And third, maybe the most important, is you manage your risk. You have to know exactly what could go wrong.
And here are the risks that are on my personal checklist. The threat of US tariffs is number one. That's the biggest question mark. A sudden strengthening of the Korean currency could squeeze their profits on exports. Any big delays in that robotics timeline would obviously be a major red flag for the growth story. And of course, a big global recession would hit every car maker. Knowing the risks is just as crucial as seeing the opportunity.
So, to wrap it all up, the investment thesis really stands on four strong pillars. 1. The physical AI play, which makes them unique among automakers. 2. The valuation floor. That low PE and solid dividend provide a real cushion. 3. The macro tailwind. That WGBI inclusion is like a guaranteed buyer coming to the market. And 4. Sheer operational excellence. They're so profitable they can pay for this entire tech transformation out of pocket.
You know, I remember the days of going all in on a story stock like Tesla, thinking it would go up forever. It was a heck of a ride. But this time around, my strategy is a bit more like Hyundai's. It's about realistic growth, with a seatbelt on. I suggest you make sure you wear your seatbelt too.
Because at the end of the day, the market is not a casino. It's an arena of survival. And making wise, calculated choices is what truly matters.
That's our analysis for today. If you got some value out of this deep dive, do me a favor and hit that like and subscribe button. It really helps the channel. Thanks for joining me on Understanding the World Through Stocks, and I'll see you for the next one.